Hello everyone, this is part 2 of Options Trading Made Simple. In this video, we'll discuss the downside risk of options as well as what it's like taking an actual loss when you get stopped out. So we are going to continue from the prior video. In case you haven't seen it yet, like if you found this video valuable, share if you definitely want to get the word out, and don't forget to also follow us. All right, so let's dive into the 21st, which happens to be this past Sunday's email. Merck, we got stopped out today, which is great in a sense because you'll be able to see how risk is handled. Now, most people, I will say, new beginners would think, okay, do I just sit in a position and hope that it will go my direction? And hopefully this is insightful that no, there are stop loss in place if your analysis is wrong. Also, if you were to trade the options on these, with options you buy time. So if I go to Merck, and what I mean by buying time, really in shares, it's not a matter of time, it's just a set price. If it hits a technical stop, you exit the trade. You take that hit. 100 shares is $1 risk, you lose $100, and that's the concept. But with options, you're in an option, and let's say your expiration is 2 weeks or 3 weeks out. You still have part of that investment, meaning you did not lose your entire option or whatever you purchased or your initial investment. You're down, yes, and you can cut that loss based off of what the share price did in terms of hitting the stop. You get out the options, or some people like to wait it out because they have time on that option to eventually allow it to work out. I'm not going to say if that's right or wrong, but I'll say what I've done in this instance. I had shares, so I did not do the options of Merck, and I simply respected the stop loss. Now, how do you lose your entire amount you invested in if you had options? Let's say this did not work out eventually up until your expiration. That's where you lose it all in terms of you only lose what you put in your option trade. Times Ernest and I, we find a lot of great setups even during the start of the week, and we want to be able to share that with those who can hold it as a swing. One being said was Beyond Meat. Provided this in Slack as a bonus trade alert. So this is outside of the Sunday emails. We like this one a lot. It was trading at $171. We like to note the earnings, possible retest of highs, or eventually break to all-time highs. And if holding through earnings, just want to make sure you realize about most of your position, 75% of it to be exact, and trailing any remaining you may have. So that could be shares. That could even be with if you're holding more than one option contract. The point is take profits, book profits, because with this process, you can always repeat it over and over and over again, weekly, monthly, yearly. It's just really the skills. Beyond Meat, what we liked about this during the time we provided it on the 16th, we noticed that, hey, nice consolidation. We love flags. I think on the other video, I spoke about flags. We went in during the consolidation before the breakout, and it eventually broke out, which happened basically this week. Today is Thursday. So Monday, we realized some amazing profits, and earnings is approaching on the 29th. So that's next week. And this is a great move, an awesome move. So not only it retested the highs or the prior all-time highs, but it also broke right through. So this is up about $49 per share from where we provided it to our members. Let's check out the actual options on these. So the options on these, we'll go over to the 172.50 calls because it was priced at, or the stock was at 171 during the time. So the 172.50 calls is what we purchased. Let's get it up on an actual chart so we know what the price looks like in terms of the shares. Now what about actually buying the options? This is the same consolidation you're looking at right here. So prior to the breakout, this was about $10. 10 times 100 for one contract, that would have been about $1,000 investment. So you sitting on one contract, simple math. You can always do more. It's really based on what you're willing to risk in terms of what you can afford to risk. I can't stress that enough. And 1, 2, 3, 4 days. 4 days. This option moved. And basically four times your money, almost 5 times the amount of your initial investment. So this is the high so far for the day. As we can see, the market's still open, and Beyond Meat is definitely pushing right up into their earnings report. So this is a great week, awesome week to actually take profit and realize profit. So from here to here, this is about a 470% return. That's the power of options. Now, that's also the power of technical trading. QRVO, let's look at that one. That one we did not look at as of yet. QRVO hit target in terms of second target yesterday. And I'll just look at the actual shares and not the options for QRVO. QRVO, we wanted to trail it to about $75.50. Awesome breakout. So this one is an alert that was provided last week. That was the 14th. There's a first target, and generally the second target for us runs into the next week. Sometimes it takes 3 weeks to hit. It all depends on the stock as well as what that chart actually looks like. Here are some key takeaways. If you are trading shares of a stock, your risk should be defined in terms of you know how much you are willing to lose well in advance, well before you enter into the trade. You also have to know what type of trader you are in terms of, are you swing trading for, or are you holding for the long haul? That all determines exactly how much risk you're going to take on with the shares. Options, I find that it's much easier to base your analysis off of the shares. And I know that with options you can buy time if you're not too technically inclined with the charting aspect. So some people like to go 3 to 6 months out. There's nothing wrong with that. Once again, with options, your risk is definitely defined. If you have $1,000 and you invest the full 1,000 into an option, meaning you max out with the amount of contracts you're able to buy with $1,000, then that's your risk. And you can cut the trade early. There's nothing wrong with that if you realize that the option is not working out in your favor. With swing trading or even trend trading, you want to have some sort of diversification where you are not putting all your eggs in one basket or one stock. Spread the risk among a few. We like to do 3 each week because the likelihood that all 3 will go wrong is slim to none. We have had plenty of weeks where we're 100% on all 3 stocks. If you're wrong on 1 or 2, there should be a stock that helps with the losses and more than carry the losses. That way you net positive, even in option trading. If we use a real life example like this email you're seeing now, FDX options 250% was the gain on those. You can see the entries and the exit with the shares in terms of the loss with Merck. $1 loss versus a $8 gain here. Or let's say you did Merck options, you should not lose no more than 30% value in your options, especially if you respect the share stock. Hope everyone took something away from this, and as always, trade safe.